NVIDIA Corp is trading at 187.76 USD, showing a decline of 1.45 or 0.77% in today's session. While a minor dip on a holiday-shortened trading day might seem like a quiet moment for the semiconductor giant, the underlying reality is anything but calm. Most investors look at these small daily fluctuations and assume the AI narrative is simply cooling off as we head into 2026. However, what the broader market is missing is a massive divergence between retail sentiment and institutional positioning. While small traders are stepping back, institutional funds are quietly rebalancing their positions, shifting capital from traditional safe havens into specific high-growth pockets. This creates a fascinating tension because the public expectation is that NVIDIA stock has reached a temporary ceiling, yet the internal metrics of the company suggest they are about to reset the entire baseline for what profitable scale looks like in the silicon industry. It is easy to look at the chart and see a stock that is already won, but the real story is found in the supply chain logistics and the sudden easing of trade restrictions that were previously thought to be permanent obstacles. The general belief right now is that the explosive growth phase for artificial intelligence hardware is behind us, and that we are entering a phase of steady, incremental gains. People think the big surprises are over, but if you look at the recent data center figures and the massive orders coming from the hyperscalers, the reality is that NVIDIA is now essentially a full-stack provider of data center infrastructure. They are no longer just selling components, they are selling the entire environment where modern computing happens. When you challenge the idea that this is a cyclical peak, you start to see that the current price action is more of a consolidation of power than an exhaustion of demand. Looking at the intraday movements and recent daily swings, we have seen NVIDIA stock maintain a relatively tight range despite the broader market volatility. The trading volume has remained robust, consistently ranking among the most active tickers on the NASDAQ. Much of this activity is driven by institutional players who are using individual brokerage accounts and sophisticated platforms to manage massive portfolios. We have seen significant inflows from institutional holders who are increasingly using Fidelity Wealth Management and Fidelity Brokerage Services to lock in long-term positions. These are not the types of investors who panic over a 0.77% dip. Instead, they are looking at the macroeconomic pressures and the recent signals from the Federal Reserve regarding interest rate stabilization. As rates have settled, the cost of capital for the massive AI build-outs has become more predictable, allowing companies to commit to multi-billion-dollar orders that provide NVIDIA with a long runway of visible revenue. The institutional activity we are seeing right now is particularly telling. Large-scale asset managers and those utilizing Schwab Intelligent Portfolios are increasingly viewing these tech leaders as the new defensive stocks. It's a strange inversion of the typical market logic where tech is seen as risky and utilities are seen as safe. Today, a company with a balance sheet like NVIDIA's and a near monopoly on high-performance compute is seen by many as a safer bet than traditional industrials facing global supply chain uncertainty. This shift is reflected in the way people are using online investment tools and online investing platforms to gain exposure, whether it is through the Robinhood app or the Interactive Brokers trading platform. The accessibility of these shares has democratized the ability to participate in this growth, but it has also increased the noise. Comment below how many shares of NVIDIA Corp you currently hold, or if you are waiting for a specific price target to enter. If we look back at the recent earnings reactions, the market has been demanding perfection. Every time the company reports, the headline numbers beat expectations, yet the stock often experiences a sell the news event. This is the expectation versus reality gap in action. The market expects a miracle every quarter, and when NVIDIA simply delivers exceptional results, some traders feel disappointed. But the reality is that the gross margins are staying incredibly high, often hovering near the 72% mark. That kind of profitability at this scale is almost unheard of in the hardware world. When you compare this to Apple stock or Tesla stock, you see different versions of the same struggle to maintain growth at a massive scale. While Tesla is navigating the complexities of autonomous driving and Apple is refining its services ecosystem, NVIDIA is the one providing the foundational compute that allows both of those companies to advance their own AI initiatives. Beyond the daily noise of the ticker, it is important to understand exactly what this business does and how it evolved into this position. NVIDIA started as a company focused on gaming and graphics, but their business model shifted fundamentally when they realized their parallel processing architecture was perfect for the complex math required by neural networks. Today, their data center segment is the undisputed engine of the company. They design the chips, but they also provide the software layers like CUDA that make their hardware indispensable. This software moat is why competitors find it so hard to gain traction. It's not just about having a faster chip, it's about the millions of developers who are already trained on NVIDIA systems. Their past performance has been a steady climb of increasing their footprint in every major tech trend, from professional visualization to automotive systems. Sector momentum is currently favoring the semiconductor space, but there are macroeconomic pressures that cannot be ignored. The global manufacturing indices have been a bit mixed lately, and while the U.S. GDP report was strong, there is a constant fear that the massive spending on AI infrastructure might eventually slow down if the return on investment for the buyers doesn't materialize fast enough. This is where the contrarian view comes in. Many analysts are worried about a bubble, but the reality is that we are seeing actual utility and actual revenue growth among the companies buying this hardware. It's not like the dot-com days where companies had no path to profit. The companies buying NVIDIA stock today are the most profitable entities on the planet, and they are using these tools to increase their own efficiency. As we look towards the future, there are several catalysts on the horizon. The mass production of the Blackwell Ultra chips is a major milestone, but the real excitement for some is the testing of the Rubin series. This next generation of hardware is expected to handle even more complex tasks, such as million-token coding and generative video at a fraction of the power consumption. There is also the surprise shift in trade policy that has allowed some sales to resume in major international markets. This could provide a significant boost to the top line that many analysts had already written off. However, the risks are real. Supply chain disruptions are always a threat in the semiconductor world, and any sign of a slowdown in hyperscaler spending would be a major headwind. The investment landscape has changed, and the way people interact with the market has changed along with it. Whether you're using Fidelity mutual funds or managing your own individual brokerage account through a Fidelity mobile app, the focus has shifted towards high-quality, high-margin leaders. We see this in the popularity of Fidelity IRAs and the way users are leveraging the SoFi trading platform or the SoFi active investing tools to build diversified portfolios. Even the more sophisticated traders on the Interactive Brokers platform are paying close attention to these semiconductor cycles. The rise of self-investing and the use of investing sites have made it easier than ever to track these movements, but it has also made the market more prone to rapid sentiment shifts. If you are looking at online investing or seeking investment help, it is crucial to separate the hype from the actual business fundamentals. The use of a SoFi robo-advisor or an intelligent portfolio can help manage the volatility, but understanding the core tension between market expectation and corporate reality is what gives you an edge. Many people look at the Robinhood crypto features or the Robinhood fractional shares and see them as a way to gamble, but the smart money is using the Robinhood investment tools to build long-term positions in companies with real pricing power. To summarize the situation, NVIDIA Corp is currently in a phase where the market is trying to decide if the current valuation is sustainable. The intraday dip to 187.76 USD is a reflection of short-term caution, but the underlying reality of the business suggests a company that is still expanding its reach and its influence over the global technology landscape. The expectation was that the AI boom would be a short sprint, but the reality is that it looks more like a fundamental shift in how computing works. While there are risks related to sector rotation and macroeconomic shifts, the company's ability to innovate and maintain its high margins provides a strong cushion against market turbulence. The contrast between the cautious retail sentiment and the steady institutional accumulation is the key dynamic to watch as we move into the new year. Whether you're using Fidelity ETFs, SoFi ETFs, or individual stock picks on the Interactive Brokers trading platform, the focus should remain on the long-term trajectory of this compute-driven transformation. The central insight here is that NVIDIA has moved past being a simple hardware vendor and has become the gatekeeper of the modern digital world. Every